Monday, January 18th, 2021, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at how debt monetization always leads to the collapse of the currency. And what is debt monetization? Well, it's when the government itself buys its own debt. And it does so by the central bank doing it for the government. Yes, we're told that the Federal Reserve and the Bank of England do not buy directly from the primary market. And what's the primary market? Well, that's the market where the Treasury comes in and issues the debt into the primary market. And primary dealers and investors buy those issuances. And the Federal Reserve is not involved in the primary market. So you might say, well, they're not doing debt monetization. But de facto they are, because the Federal Reserve is promised to do QE to infinity, no limit to QE. So what does QE mean? Well, it means that the Federal Reserve comes after those auctions and buys those treasuries for the secondary market. It doesn't even have to be the next day, maybe a week later or a few days later. The primary dealers and investors know the Fed is going to buy that from them, and usually at a higher price. So there's an incentive as well. It's basically free money for the primary dealers and for the investors or hedge funds that are in the know. And I'm going to show you here through a very good chart from Tavi Costa, who I've interviewed before on this channel, of how the U.S. Treasury is really being helped by the Federal Reserve. You can see here, in November and December, the government issued $505 billion worth of Treasury notes and bonds. Well, what are notes and bonds? Well, they're anything, any debt issued by the Treasury more than 1 year in maturity. So anything from like 2 year to 30 year. And as you see here, historically, it's a massive amount of issuance or debt. Of course, it's not surprising. We've had all the support, fiscal support in the last 10 months or so because of this crisis. We're going to get more coming with the Biden administration. Trillions upon trillions of more debt. And we've seen, yesterday I spoke on my live stream about how the EU is going to try to be less dependent on the US dollar. We've seen recently that the Russian central bank, for example, they hold more gold than dollars. They've been getting rid of their dollar reserves. The Chinese are chipping away at their dollar reserves. It's been, I think, the lowest in terms of what countries hold in terms of dollars as their reserves. It's the lowest in many years. It's only 60% of global reserves now. So if the Fed doesn't help, there's only actually one thing that can happen. Interest rates have to go higher, so to attract buyers from the private market. I wanted to show you as well what the primary dealers are. Basically, they're the people that participate in the auctions of the U.S. Treasury, and they're primary dealers to the Federal Reserve Bank of New York. So they're all the big banks, as you can see here on this list. We've got Barclays Capital of the UK, Bank of America, Cantor Fitzgerald. That's different. They're not a bank, but they're more of a broker-dealer. But you've got Citigroup, which is Citibank, Credit Suisse, all the too big to fail banks, Deutsche Bank, Goldman Sachs, JP Morgan, NatWest, UBS. So these people, along with their clients, they bid for the auctions. Yes, there are foreigners still who bid for the auctions, but I think they're moving away from that as most as possible. One of the reasons is that they know the dollar is dropping. The other reason is political, because the dollar is used as a tool, a political tool in the last few years. It's probably not going to change. The EU is setting its new policy to try to avoid the dollar as much as possible. From tomorrow, even though we have a new president, they don't seem to differentiate. They think the policy of using the dollar as a tool for sanctions is going to continue. So I think this is the slippery slope to hyperinflation, to the loss of confidence in the currency when the government, through the central bank, and yes, the central bank is privately owned, the regional banks, but they've been given this monopoly from the government. They are working together. Yeah, when that happens, that the government itself has to buy its own debt. And I think it will click one day. People will realize that the government is buying its own debt, that it doesn't make sense. It's like me borrowing money and lending it to myself. It doesn't make sense. It's not real. And at the moment, there's a big delusion. Wall Street, big investors, pension funds, they still think it's a safe haven, that it's a safe security. But that's what the German government was doing in the early 20s before the collapse of the Reichsmark or the hyperinflation there in 1923. So you can see here that Tavi Costa is noting that the Fed only bought a third of that. And I think it's going to get bigger as we move along. And the problem is, the economies are slowing down. We've got lockdown still. I think a lot of people, the consumer has been hit mentally. The confidence in the system has been hit. The bottom 50 or even more percentage of the population is not doing well. Small businesses are going to be devastated or basically destroyed. And there's going to be a lot less tax receipts from the private economy because taxes are only generated by the private economy. So if the government can't generate tax to finance running this debt, you can see why higher interest rates are a big problem. And that's why the Fed is going to keep printing money or printing reserves, if you want to call it. And they're not, when they do the QE, they do not swap reserves for treasuries. They buy the treasuries. Swap is a derivative. When a transaction goes onto the balance sheet, it's a purchase. And that's what the Fed's going to do. And especially with all the talk of a new stimulus next month, probably. What is it? 1.9 trillion. Talk of also infrastructure spending, trillions of that. And how many months until we're going to get another stimulus? Is it going to be 2 trillion in 3 months' time or 3 trillion in 6 months? It's just getting out of hand. And I think the other countries like the EU and the Bank of England in the UK, they're going to follow along. Of course, they don't have as much wherewithal to do this because the dollar has been the reserve currency. And unfortunately, the Federal Reserve is still the central bank for the world. So yes, this always ends in tears. How can the dollar strengthen with such a policy of debt monetization? Yes, legally, it isn't debt monetization because the Federal Reserve is not going into the primary market. They're not buying directly from the auctions of the Treasury. But that could even happen as well, actually. And I think we're going to see the trouble reflected, the symptom of that this is happening, that the dollar is losing value very quickly, is going to be higher commodity prices, higher precious metals prices, and a lower dollar, of course, versus other fiat currencies. But I think commodities and precious metals are going to go up faster than the other fiat currencies. So other fiat currencies are not a hedge for dollar weakness, even though it will protect you a bit, but the ultimate hedge will be hard assets. So with that, let's look at where the markets are this morning. It's just gone past 8:30 a.m. London time. Yesterday, when the markets opened, they opened the futures market where you trade the the futures on the stock market indices, the currencies, the precious metals, commodity, they open around 11 p.m. London or 6 p.m. New York. And I noticed that gold and silver got hit really hard right off the bat, maybe 15, 20 minutes after the open. And gold traded almost down to 1800. The low was 1802.50. I did say last week, I think Friday, that the technical picture in the short term didn't look very good for gold. So I wasn't surprised that gold and silver were hit. Silver got down to 2402. But right now, I was surprised. Pleasantly surprised, I guess, because gold has rebounded and is now at 1835, up $5. The high's been 1841. I think we're just below the 200-day moving average, so we have to keep an eye on that. I think that's just below 1850. Silver is looking pretty good. It's now trading at 25, so $1 higher from the low overnight. It's up almost 1%. The Dow futures down 62. The S&P futures down 8, NASDAQ future down 14. The foreign exchange market, we've got sterling or cable down 1/3%, 135.40. The euro is unchanged, 120.77. The dollar's down 1/8% versus the yen at 103.74. And actually the dollar is strengthening back against the yuan. We're now back above 650. I saw some headlines that the Chinese economy grew at like 6.5% or something, GDP. Can you really trust the Chinese data? I don't. I don't trust any government data. But the Chinese, of course, have to keep a semblance that things are going well because they have a huge population. And if you get trouble in that economy, socially, it's a big warning sign, I would say. What about some other commodities here? Well, we've got high-grade copper up 2/3%. We got WTI crude down 0.5% at 52.09. So yes, crude oil has moved down since the highs maybe a week or so ago, almost around 55. So the 10-year yield to finish off is at 109, down 1 basis point. So bond market pretty calm right now. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Facebook, BitChute, Hive, DTube, Library. And you can also follow me on my blog, moneco64.net. I don't post the videos there, but I write articles once in a while, and I've been posting a lot more there since I left Twitter, moneco64.net. So I wish you all a great day. Take care. Bye.